We're going to talk about budgeting. Now, a company of any size is a huge organization, hundreds of people in different departments, sometimes in different cities, all supposed to be working together. And one of the big problems is how do you get them all going in the same direction, all knowing what to do? And one of the ways in which you can do this is to use the management accounts in particular, use them for budgeting. And a budget is essentially a plan as to what you're going to be doing in the next year. So it gets everyone together to coordinate what they're doing. And the reason why it's convenient to group it around the accounts, because that is the end result. That's what you want to improve. And the accounts also fit together all the costs, so they're a good way of adding up lots of different activities in an economic manner so that you know that the total makes sense. So in that sense, a pound is serving as a useful measure of activity and a way of combining different activities. So you're going to come across budgets if you get into any sort of managerial position. So it's useful as a business student to understand how they operate. Okay, so let's just have a look at our outcomes here. Define a budget, show how budget, strategic objectives and strategic plans are related. Okay, we'll have a go at that. Explain the budgeting process and the link between various budgets and the business, and that's where the financial coordination comes into play. The uses of budgeting and the relevant data there, and then show how flexing the budget can be used to exercise control, and more generally how budgets can be used for control purposes. Okay, so I was talking about the planning process, and you can see it's a lot of different activities. I've broadly divided them up into the blue ones, which as you can see is really related to sorting out your strategy, and you can't really start to talk about what you actually want to do unless you have decided at the higher level as to which direction you're going to take. And to that we give the general term strategy. So there's some breaking down of strategy here. The blue area: establish your mission, undertake position analysis, strategic, looking at strategic options. So this can be something like looking at your competitors, a competitor analysis, and in your other business studies you'll be looking at various ways of of analyzing your competitors. In America they're particularly strong in this area. And then you select your strategic options, what you're going to do, what activities you're going to undertake. Only when you've decided all that in your strategic position can you then start to prepare a budget, the red area. And then the green area, you perform and collect information on actual performance, and then you compare it against your budget. And in doing that you can identify where the gaps are, and then we go to the purple area, which is where we're looking at variances and where we need to take action, revise plans and develop new strategies possibly. So we end up going back to the blue, and so it goes round and round in a circle. Strategy, budgeting, analysis in the green area, and then what we're going to do about it all. There are various types of budget, as you can see there. Well, it can be broken down in any number of ways. It's not just this particular format, but this is an example where every area is so large that it requires its own separate budget for a large organization. In a smaller one, it's all going to be done in one go, centered around the profit and loss account or income statement and the balance sheet, or what did you call it, statement of financial position. So we've got these various budgets: trade receivables, that's sales. We've got production budget. So you tend to start by deciding your sales, then you know what your production is going to be. If you know what your production is going to be, then you know what your raw materials are going to be, and then you'll know what your finished inventories are going to be. From the trade receivables, that's money coming in, you know what your money going out is, so you can start to draw up your cash budget. Your cash budget will involve overheads. An extra item is the capital expenditure budget. Because you know your production, you then know your direct labor as well, and also because you know your production levels, you know what your trade payables are going to be, and then you know what your raw material purchases. So it's all kind of interlinked, starting with your sales level, then your production output to meet those sales, then everything else falling into place with the additional activity of capital expenditure. So looking at the sales budget, that can be broken down into simple regions like that. It'll involve information from managers, it'll involve the sales strategy, whether you're going to launch new products, that sort of thing. Okay, so I've been talking about budgets as just a general communication exercise. We've broken it down a bit here: promote forward thinking, motivate managers. Well, yes, there's the motivation side, provide a basis for control, system of authorization, and coordination. So I've really been talking about coordination. If it's not in the budget, then it's not authorized, so it's also authorization. So people are keen to discuss the plans and get it in the budget, because then you know the firm can afford it. As a basis of control, because you compare the budget with the actual performance and see where things differed from budget, not necessarily went wrong, but just differed from the budget. Motivating managers, we'll talk about that at the end of this section, not this recording, but in the final recording. But sometimes budgets can be set as targets, something to aim for, and in that way provide a basis for motivation. And then just generally promote strategic thinking, because you can't decide what your sales are going to be for next year unless you've got some sort of a formulated larger plan. Okay, so those are the various subtleties of how and why we use budgets. Accuracy of revenue budgets, well, this is just a particular view. I wouldn't say they're always accurate, but they, as you can see there, 10% margins are quite large if your profit margin is, say, 2 or 3%. So quite small differences in sales can have a dramatic effect on your profits, and there are some drastic cases as well. Okay, we're going to be looking at this in the next session, where we look at budgets in detail.